Okay, thank you for joining us. My name is Brian Kerrigan. I'm an advisory partner with Whittlesey. I will be the co-presenter today. During the past year, we've spent a lot of time with clients on these government incentive programs like PPP and the ERC credit. Today, we'll talk about the ERC credit. I will turn it over to my partner, Brenden Healy.
Thanks, Brian. Welcome, everyone. My name is Brenden Healy. I'm a tax partner with the accounting firm Whittlesey in Hartford. We're the largest independent accounting firm in the Hartford area, but we do a lot of work with business owners and family closely held businesses, family-run businesses. But this credit we're going to talk about it's an incredible credit, and as whether you're familiar with it or not, and we have a quick poll we'll put up soon. But we want you to walk away with some knowledge and understanding about the credit and how it's going to help your business, because it's a very powerful credit we want you to try to take advantage of. So with that said, Molly, do you mind putting up the poll now? We just want to get a sense of how familiar folks are. We're just doing a quick survey, obviously. We're just curious ourselves how familiar you are with this credit. And we're doing this poll because we find that as we talk to business owners, there's not a lot out there that are very familiar with it. Some may have heard of it, a lot of them haven't heard of it. And we're just curious from this audience who is familiar with the credit. So we'll give you a little bit of time to fill out the poll. And as we're doing that, let me just start, and I don't mean to talk over you if you're answering the poll question, but I will. So this credit we're going to talk about it's a tax credit. And what that means is, for those that don't know, if you qualify for this credit, whatever it is, let's say it's $10. It's a lot more than that, but let's just pretend it's $10 credit. What it does is if you qualify for the $10 credit, it reduces your taxes by $10. And not only does it reduce your tax, but it actually could put you into a negative tax situation, which means the government could write you a check. So this credit is not only a tax credit, but it's a refundable tax credit, which means even though the credit could bring your tax down to zero, it can actually get you money back beyond that. So it's just a very powerful tool. And Molly, whenever you have those results, just let us know. Okay, this is great. This is so we've got a good gamut across the folks. So good. I'm glad to see that. So hopefully everyone takes something away from this session. I will say, if you want to ask questions, we'll be watching the. Yep, Jeff, I'm going to answer that question in 1 second. So we'll be monitoring the questions, and then we'll also have some time at the end for questions and et cetera. So we'll try to get to some of your questions during the presentation. Most of those questions will be at the end. So it's a tax credit. It's a refundable tax credit. And to answer Jeff's question, it's a credit against payroll taxes. So it's not an income tax credit. It's not a corporation tax credit. It's a payroll tax credit. So you apply for this credit. If you qualify, you apply for it using your payroll tax filings. And it's a federal credit. So the Form 941 is key for this, for claiming this credit. But again, as you'll see, as we walk through the numbers, these numbers are incredible, and we're seeing clients, if to make up numbers, if their payroll tax number or liability is $10,000, but the credit is $20,000, you not only get the $10,000 back, but you get another $10,000 back from the government because it's a refundable credit. So again, it's a great credit. So we'll talk about some of the changes for the employee retention credit in a minute. We'll walk through the eligibility. There's really two tests. There's a revenue decrease test, which we'll go over in more detail, or there's this full and partial shutdown test. And Brian will go into more detail on that, but the full or partial shutdown is more of a grayer area. you'll have a more of a need for documentation. I'll let Brian go over that in more detail. So not only do we have to have either a decline in gross receipts, which we'll go over those details, or this partial shutdown, but if we meet one of those two tests, we can then take a certain amount of our employee wages and calculate the credit based on that. And then the last bullet point on the slide, why claim the ERC? Frankly, it's a great gift from the federal government, as we'll see shortly. So we can go to the next slide. There was, as we get to the next slide, there is, yep, perfect. So there's really, this is a new credit. It was created in 2000 as part of the response to the pandemic. A lot of us are familiar with the PPP loans. That was kind of one part of the stimulus created by Congress, but also this tax credit. And initially, it didn't get a lot of traction because the law said you can either take a PPP loan or this retention credit, this employee retention credit. So most businesses went after the PPP loan, and I agree that was probably the best thing to do. So they kind of focus on this, not necessarily this credit. Fast forward through 2020 into late 2020, they then expanded, they changed the rules and they said, listen, even though you took a PPP loan, that's okay. You can also go back and get this. You could also take the employee retention credit. So they expanded that, which is wonderful. The only caveat to that is when you, as many of us know, when you apply for forgiveness with the PPP loan, you have to show the bank and the SBA the wages that you're using for the forgiveness portion. You cannot use the same wage dollars for PPP forgiveness and for this tax credit. So you could still, if someone makes $100,000 and you use 50 of it for a PPP, you can use 50 of it for this credit. Although, as you'll see, the credit is capped at $10,000 of wages. But the point is you can get both PPP and this credit. And then the third change was it enhanced the credit so that not only is it in 2020, and the second change allowed this credit to be calculated for the first and second quarters of 2021, they expanded it to all 4 quarters of 2021. So again, Congress has done a great service to businesses in this credit, and hopefully you guys can take advantage of it. Can we go to the next slide, please? So this is a quick overview of the 2020 rules. 2020, there are 2020 rules, and then there are 2021 rules. So it's a tax credit based on 50% of qualified wages that are capped at $10,000 per employee for the year. So simply said, in 2020, if I qualify for this, and if I paid an employee at least $10,000, I take their $10,000 of wages times 50%, that equals $5,000 of a credit that I can claim for 2020. And if I can do that, once I qualify, I can do that for all my employees. And as you can imagine, $5,000 times the number of employees adds up to some real money quickly. Next slide, please. In 2021, there was a few changes, but the biggest change is, number one, you look at it on a quarterly basis, meaning I can claim this, if I qualify, I can claim this thing 4 times in 21, whereas for last year, 20, I can only claim it once, but for 21, I can claim it 4 times each quarter if I qualify. And they also increased it to a 70% credit. So same $10,000 max, and now on a quarterly basis. So if I pay an employee $10,000 within the quarter, and I qualify for this, I can take a $7,000 per employee credit each quarter in 2021. So if you're not familiar with this credit, as you can see, the math gets very high very quickly, and this is a wonderful, wonderful credit for you. Next slide, please. So as this credit morphed over the last year and a half, they expanded it to public colleges, universities, and some public healthcare entities. So having said that, I will remind us, if we're a nonprofit, we should be looking at this as well. And I covered this second bullet point. The wages increased from a $10,000 an annual thing to a $10,000 per quarter. We talked about the increase in 50% credit or $5,000 max to $7,000 max. I'm going to hold off on this fourth bullet point, the gross receipts test. I'm going to go over that in a second. If I'm an employer with less than 500 employees for 21, I'm okay. There's not an additional restriction. If for 21 I have 500 or more employees, there's this concept of you have to essentially pay people not to work. You have to. The whole point of this credit was to supplement and help employers keep people on the payroll. Similar to the PPP loan, they wanted to provide this credit to keep folks employed. So as they kind of change the rules for 21, if I have 500 or more employees, there's another rule that I have to deal with, which says you essentially have to pay people not to work in order to claim this credit. I don't want to get into that nuance right now, but I just want to say it out loud. They also expanded to say that employers that are non-existent in 19 are available for the credit or can be eligible for the credit. And then, so if I have the final bullet point, if I have less than 500 employees, I can qualify for an advance payment of the credit. So if I know I'm going to get the credit for Q3 of 21, or well, Q2, we're still in Q2, I can apply for advance payment of that versus waiting to apply and getting a refund of that credit. So there's ways to get the money in your hands quicker, especially if it's a big need. Before we go on to the next slide, I want to focus on the decline in gross receipts. So there's really two ways to get the credit, and I'll oversimplify it for purposes of this discussion, but there's really two ways to get the credit. The first way is I have to have a reduction in gross receipts. That's top line revenue, not net income. I could have a loss. I could have made more money. We're not talking about net income. We're talking about top line revenue, gross receipts. So if I have a reduction in gross receipts that hits a certain threshold, I automatically get to qualify for this credit. And how do I look at it? I look at 2019 as a base year. So in 2019, there's 4 quarters, Q1, 2, 3, and 4. So those Q1, 2, 3, and 4 on a calendar year basis, 2019, that's kind of the base. And then for 2020, I look at each quarter in 2020, and if I have a quarter in 2020 as compared to 19 that has 50% or greater reduction in gross receipts, so I'd had to have a drastic decline in gross receipts. If I hit that threshold, I qualify for the credit for 2020. The good news for 2021 is that 50% threshold, which is that's a big hurdle to get. We've got a lot of clients that took hits in Q2, Q3 of 2020, but unless you're in a really devastated industry like the hospitality, restaurant industry, et cetera, unless you're in one of those industries, a lot of folks did see substantial declines, but 50% that's a big threshold to hit. So for 2020, it's a 50% threshold in any one of the 4 quarters does, and so you compare 19 to 20. Then fast forward to 2021, you still use that 2019, those quarters in 2019, but in 2021, you compare Q1 of 21 to Q1 of 19, Q2 of 2021 to Q2 of 19. And you do that comparison, and it's a 20% decline in revenue that we're looking for. So they shrunk the threshold, if you will, to make it easier for folks to get the credit. Can we hop to the next slide, please? So for 2020, employers must have been in business during 19 to take the credit for 2020. And then, as I mentioned, you have to have received greater than 50% reduction in gross receipts. Next slide, please. And then 2021, again, we adjusted it. You don't have to be in business for 19, but to claim the 21 credit, you have to have been in business in 2020, and then you can claim the credit in 21. And then, but you also have to hit that 20% test as well. So, stepping back to the eligibility, there's two tests I mentioned. One is this gross receipt test. The other test that Brian's going to go into more detail in is this this either full shutdown where the government said, hey, Brenden Healy, let's pretend you're not an accountant and you own a restaurant. Hey, we're telling you, you have to shut your restaurant. So the government told Brenden Healy, in my example, to shut down my restaurant. Well, because of that governmental order, I automatically qualify for this credit. I don't even have to look at the gross receipts if I don't want to. I can, and likely I would hit that test, but because of the governmental shutdown, I qualify for this credit. So there's a shutdown, and then there's this partial shutdown or partial suspension of my operations. And again, that's the grayer area that Brian's going to get into. So there's two tests. Again, don't mean to beat it to death, but I will. One is a gross receipts test. The second test is this full or partial shutdown. And if you don't meet the gross receipts test, you don't hit those thresholds, you really should focus and key into what Brian's going to talk about on this full or partial shutdown, because it's very important. Can we hop to the next slide, please? And again, this is an either or test. So all I have to do is meet the gross receipts decline test. And again, I'm using 2019 as my base, comparing it to either any quarter in 20 or the quarters in 21, but always using 2019 as the base. So I look at that test first, and then if I don't meet that test, I go to this, either was I forced to shut down by the government? Did the government tell me to shut down? Or did I have a partial shutdown due to a COVID-19 related issue, a government restriction or something like that? So with that in mind, I'll hand over the reins to Brian.
Thanks, Brenden. I think what I'll do first is I'll just go through the questions that we've gotten so far. We've gotten 6 questions, so this is probably a good time to answer those questions. The first question is, what about nonprofits that don't pay tax? This is a payroll tax credit, so nonprofits can benefit from it if they've been fully or partially shut down or met the revenue test. Second question, are the 2020 wages for the entire year or only after March when the law came into effect? It's March 12th, 2020 through the remainder of the year. So yes, it's not your entire 2020 wages. They start after March 12th. Someone's saying, again, that's assuming that the funds were not used for payroll on your PPP forgiveness application. That is correct. You cannot use the same wages for PPP and in the employer retention tax credit. Next question is, does this only apply to full-time employees or part-time as well? You can use the wages of part-time employees. The full-time calculation comes into effect in 2020. If you had more than 100 full-time employees, you have to basically pay people not to work. In 2021, if you had more than 500 full-time employees, then you have to pay people not to work. So that's where the full-time employee piece of it comes into play. Ed asks, if I had a PPP loan for $250,000 and used the entire $250,000 for payroll, I do not qualify for the ERC. I guess I would caveat that by saying, do you have any other payroll other than the $250, or is the $250 your entire payroll for the year? So you may go ahead.
I'm sorry, Brian, and we just to expand on that. I don't know Ed's facts, but some of us filled out our PPP forgiveness applications and threw all the payroll we could in there, even though we didn't need all that payroll and so the IRS has said, if you only needed this much for the PPP forgiveness, but you reported this much on the app, well, just, you can still use the payroll that you didn't need for the forgiveness, even though you may have reported it on the application. So just a point of clarity there.
Yeah, and then the last question, is there a look back test for gross receipts? So in the first quarter of 2021, you can look back to the Q4 analysis to determine eligibility for the credit. So if you're in 2021, you can look at the 2020 Q4 results, compare them to 2019. If you're down by more than 80%, then you can take advantage of that special look back period. We got one. ERC cannot overlap PPP. That is correct. You need to use separate wages for each program. Is there a qualification worksheet page available online? No, not really. I think, basically the calculation is relatively straightforward. I think it's the eligibility that is more difficult. So the calculation, you would need to run your wages during a non-PPP period and multiply those wages up to $10,000 times 50%. So I think, we can certainly work with you if you need help calculating the credit. Our PPP was effective 2/1/21 and will expire 7/19/21. I can begin ERC after 7/19. Yep, you could potentially take the ERC. We're assuming that you qualify. So you would have to determine in the third quarter of 2021 whether you've either been fully or partially shut down, which is not likely given that we're reopening up Connecticut at this point, or you've had a greater than 20% gross receipts drop. So Brenden, I'll stop there. There's a couple other questions I think we'll probably hit on. Are owner wages eligible for ERTC? No, they're not. So I think that the questions keep coming in, but I think we'll continue with the presentation, and then if you can monitor the questions, we'll certainly do another round of questions at the end. What I'm going to talk about is not the gross receipts test. We're basically assuming that you don't meet the gross receipts test, and do you have a full or partial shutdown due to a government order? So what we're looking for is an order that limits commerce, travel, or group meetings for commercial, social, religious, or other purposes due to the COVID-19, and they relate to the suspension of an employer's operation of its trade or business. So, in real words, basically, we're looking at the activities of the business being impeded due to a government order that restricts commerce. Orders that are not from the federal government must be from a state or local government that has jurisdiction over the employer's operations. The governor's orders in Connecticut, which basically closed non-essential businesses, would create eligibility for purposes of the ERC. Next slide, please. An employer that operates an essential business is not considered to have a full or partial suspension of operation if the governmental order allows all of the employer's operations to remain open. So, for example, accounting firms were considered essential businesses. We were able to stay open. We did have to move to remote work, but we were still able to stay open and work remotely. So we didn't necessarily have a full or partial shutdown of our operations. An employer that operates an essential business may be considered to have a partial suspension if more than a nominal portion of its business operations were suspended by a government order. So what you're looking for here is you're looking for a company that was essential but has some sort of a non-essential element to it that was shut down by a government order. And if that's more than a nominal piece, which we define as 10% of revenue or 10% of activity, then they may, even an essential business, may have a partial shutdown. Next slide, please. So an employer that maintains both essential and non-essential business operations, each of which are more than a nominal portion of their business operations, can have a partial suspension because they've got an essential business which is still running as if the pandemic didn't happen, but they have a non-essential portion of their business. And because that's more than a nominal piece of their business, they can have a partial suspension even though a portion of their business is essential. An essential business can also have a partial shutdown if a government order has reduced their normal working hours. So if you had a restaurant that, effectively restaurants were shut down in the beginning, fully, at least for indoor dining. But let's say you had, you originally you're open till 12 o'clock and the government said you can only be open till 8 o'clock. That could constitute a partial shutdown of your business operations. Next slide, please. The next one we're going to talk about is supply chain issues. So employers whose business operations are fully or partially shut down because they cannot get parts or materials that they need from their supplier who has been shut down due to an order under COVID, can basically qualify for the credit. So here what you're looking for is, an inability to obtain critical goods or materials from suppliers because the supplier is partially or fully shut down. So we were seeing a lot of this early in COVID where you had suppliers who were shut down. You couldn't get the goods from that supplier or from another supplier. So you essentially had a partial shutdown due to a government order. We talk about supply chain in 2020, but supply chain is also an issue in 2021. And there's some nuances to whether that's demand related or whether that's due to a government order. But, if you're having supply chain disruption in 2020 or 2021, you should definitely consider the credit. Next slide, please. So we're going to give some examples. So an employer operates an auto parts manufacturing business. The employer's supplier of raw materials is required to fully suspend its operations due to a governmental order, and the company is unable to procure these raw materials from an alternate supplier. Because of the suspension of the employer's supplier's business, the employer cannot perform its operations of reselling auto parts or manufacturing auto parts. So under those facts and circumstances, this would be considered a partial shutdown due to supply chain issues. Next slide, please. An employer's operations could be considered to be partially suspended if the operations that are closed are more than a nominal portion of the business operations. And we touched on this briefly a little bit earlier. More than a nominal piece means greater than 10% of your revenue or greater than 10% of your activity. And we'll talk about that in the context of our next example related to restaurants. If that's fine, yep, it's okay. So we're on to the next slide. So this is restaurants. A restaurant in the beginning of COVID was required to close their on-site dining. Their on-site dining was considered more than a nominal portion of their operations. And even though they could continue to offer food or beverage service to the public on a carry-out, drive-through, or delivery basis, they were considered to be partially shut down because their indoor seating, their indoor dining was more than a nominal piece of their operations. So restaurants in these circumstances who were open for carry-out, drive-through, and delivery were still considered partially shut down because they couldn't have indoor dining. Next slide, please. So we're going to use the same facts as the previous example, except 2 months later, under a subsequent governmental order, the restaurant is permitted to offer sit-down service in its outdoor space, but its indoor dining service continued to be closed. So now during this time period, the restaurant is offering sit-down service outside. They're offering carry-out service, delivery services, but they can't offer indoor dining. And since indoor dining is more than a nominal portion of their operations, they're still considered shut down, even though they do have the ability to serve customers outside and through takeout or delivery. Next slide, please. So the following month, under a further governmental order, the restaurant is permitted to offer indoor dining service in addition to outdoor sit-down and carry-out service, provided that all tables in the indoor dining room must be spaced at least 6 feet apart. So in this case, the spacing constraint basically takes, the 100% capacity that you have in your restaurant down to a number that is less than that. And that could result in a partial suspension of your business operations because your indoor dining is now open, but it's not open to capacity because of social distancing restrictions. Next slide, please. An employer that reduces its operating hours due to a governmental order is considered to have partially suspended its operations since the employer's operations have been limited by a government order. So if you're normally open 24 hours a day, and there'll be an example of this coming up, and you have to close to clean the plant or to sanitize the retail space, then you could be considered to be partially shut down. Next slide, please. So this is the example I was just referring to. We've got a food processing facility that normally operates 24 hours a day. In order to comply with a governmental order, they needed to clean, they needed to reduce their daily operating hours by 5 hours per day so that they could do the deep cleaning. This employer is considered to have a partial suspension of its operations because it had to reduce its hours of operation. So, if you're normally open 18 hours a day and because of a government order, you can only be open 12 hours a day, that's considered a partial shutdown for purposes of the ERC. Next slide, please. Employers that operate a trade or business in multiple locations and are subject to state and local government orders requiring full or partial suspension in some but not all of those jurisdictions are subject to a partial shutdown. So the typical example that we use in this case is retail locations in a multi-state environment. One state basically shuts down the retail, the other state allows the retail to remain open. Because you operate in some states that have required a shutdown of your retail operations, you have a partial shutdown for purposes of the ERC credit. Next slide, please. If you have to modify your business operations due to a governmental order and that modification has more than a nominal effect on your business operations, then you could have a potential shutdown. Some examples are limiting occupancy to provide for social distancing. That goes back to the restaurant example, where if you can only have 50, everybody has to be 6 feet apart. You may only be able to have 50% of capacity as opposed to 100% capacity. If you require services to be performed only on an appointment basis when you normally offer walk-in service, that could be another example of a modification that results in a shutdown. And if you have to change the format of your service, for example, there's a restriction on buffets or self-serves, but not prepackaged or carry-out, then you may also have a partial suspension of your business operations that has more than a nominal effect on your business. Next slide, please. So this slide takes us back to the decline in gross receipts test. So you either have to have a full or partial shutdown, or in 2020, a greater than 50% gross receipts reduction from 2020 to 2019. So most of our clients, if they had the gross receipts reduction, it was in Q2 of 2020 when they compared Q2 of 2020 to Q2 of 2019, they had a 50% reduction. Once you have that 50% reduction, you can continue to count wages for purposes of the ERC credit until you get back to 80% of the applicable amount in the quarter in 2019. So to give you an example, let's say we're down 50% in Q2 and we're down 25% in Q3. We can take the Q2 wages when we're down 50%, that starts the credit calculation. And then we can take the Q3 wages because we have not exceeded 80% of 2019 in the third quarter. So again, the caveat to that is most of the companies that we work with did get PPP during those time periods. So you also have to consider that as well. For 2021, the reduction in gross receipts needs to be at 80%. So you compare to the less than 80%. So if you compare 2021 Q1 to 2019 Q1, you're less than 80%, then you would be eligible for the credit for that quarter in 2021. And when you meet the revenue test, you're eligible for the entire quarter. When you meet the full or partial shutdown test, you're only eligible for the time period during which you are fully or partially shut down. Next slide, please. So they came up with some special rules that you're not, if you were not in business in 2019. So you can basically compare your gross receipts for the calendar quarter of 2021 to the corresponding receipts in the corresponding quarter of 2020. The example is an employer not in existence in the first quarter of 2019 would compare gross receipts in the first calendar quarter of 2021 to its gross receipts in the first calendar quarter of 2020. And there are some alternative quarter calculations that are probably beyond the scope of what we're talking about today. But if you're not in business in 2019, there still is potential relief available to you if you have that gross receipts reduction from 2021 back to 2020. Next slide, please. So we've talked about a lot about qualification. This slide talks about qualified wages, and this goes to one of the questions that we got earlier. What wages are eligible? Non-PPP wages between March 12th, 2020 and December 31st, 2021 are eligible for the credit. As I said before, if you have a full or partial government shutdown, you can only use the wages during the shutdown period. If it's a period in which you're experiencing a revenue decline, you can use a quarter. Full-time employees, not full-time equivalents, are used to determine the number of employees for purposes of the 100 full-time employee test in 2020 and the 500 employee test in 2021. In both those cases, if you exceed those numbers, you had to pay people not to work. Self-employed individuals are not eligible for the ERC. Next slide, please. So we've talked a lot about this during the course of the call, but basically PPP borrowers can now claim ERC credits. That was a change from the original rules. As we talked about, you cannot claim credits on wages used for forgiveness. Employers that received a PPP loan would not, in a lot of cases, have not evaluated whether they would have qualified for the credit or not. And they're going back and doing that analysis now. Most employers will have wages in excess of their PPP loan, so they could be eligible for the ERC. But really what this comes down to is you really have to go into this analysis with a focus on maximizing your PPP forgiveness and maximizing your ERC. So one of the nice things about PPP is they gave you effectively 10 weeks worth of wages, but they gave you 24 weeks to use it. So what we've been doing with a lot of clients is saying, okay, if we needed 12 to 14 weeks to effectively use the proceeds, what we're going to do is we're going to start taking ERC as of March 12th and maybe take ERC from March 12th through May or June, and then start claiming wages for the PPP so that we can maximize forgiveness. So there's some maximization strategies that we've been putting in place to maximize both the PPP and the ERC. Next slide, please. So how do we claim the ERC for 2020? We got to file a 941X. So that's an amended payroll tax return to claim the credit. For 2021, you can either, for now, at this point, we're past Q1, so you would probably need to amend your Q1 filing if you're eligible for the credit. But if you know you're going to be eligible for the credit in future periods, you can reduce payroll tax deposits. You can file a Form 7200 to get an advance credit, or you can file, an original 941 or a 941X to claim that credit. Next slide, please. Why claim the ERC? Well, I think, one of the things that we've seen throughout the pandemic is that, companies have struggled from a cash flow perspective. PPP has certainly helped with that, but ERC is another avenue to help use, buttress your cash flow while we wait for, hopefully the world will open up in the third and fourth quarters of this year. Hopefully it's starting in the second quarter of this year. But this gives you an additional safety net. If you're eligible for the credit, you can get a refund on payroll taxes that you've previously paid, and basically put another type of cash flow into your business. Next slide, please. So one of the things that's really important to us is, Brenden and I are really committed to helping small businesses, and we really want to make sure that small businesses are getting this credit if they're eligible for the credit. So we're certainly making ourselves available for a free 30-minute consultation if you want to talk about your specific facts and circumstances. I think especially when it comes to full or partial shutdowns, there's a lot of analysis that goes into that. If you're down greater than 50%, that's pretty easy. Then you just have to worry about the credit calculation and amending the 941. But if you're claiming that you're fully or partially shut down and it's not in an example that's specifically covered by the rules and regulations, there's a lot of work that goes into that. And like I said, it's very specific to your facts and circumstances, and we'd be certainly willing to talk to you about that for 30 minutes. With that, I'm going to wrap up our portion of the presentation. I guess, Brenden, do we have any questions that have come?
Yeah. We do, and I've been typing away trying to answer some more specific questions.
Okay.
But Brian, can we go back to, there's a few questions about owner wages, and I think this goes back to the the related party type stuff. So some folks have asked, there's a few questions about owners of a corporation, owners of an S corporation.
Mm-hmm.
So is it fair to say that and I'll just say it, I feel that owners are considered related and therefore may not qualify, but I don't know your thoughts.
It's not even the definition of related. It's the rules basically say that owner compensation is not allowed. So whether you're an owner of a C Corp or an owner of an S Corp, your wages are not going to count for purposes of the ERC.
Okay. All right. And then Jeff asked for an example of an essential manufacturing company under 500 employees with increased sales who work 24/7 but couldn't find enough workers that would qualify for this credit. So Jeff, that might be kind of an off, maybe a sidebar. We could chat about that. Is this credit for employees hired on or before 2019 and still employed?
There is no specific, it's not like PPP where they have to remain employed and you have to compare it to a base period. Those are not issues with this credit.
Yeah. Merrill asked, we filed a 7200 form advance for Q1 21 and our 941 with a refund due. Any idea how long it takes to get the refund? Sorry, Merrill. We are seeing some, I've seen some get it quickly. I've seen some get their refunds in a couple of weeks, and that's quick for the IRS. But and this is not an income tax discussion, but I will tell you that we're seeing the IRS take 9 months to a year for some refunds on the income tax side. So this is a new credit. I think they're still figuring it out. I would just say to be patient with the refund.
Yeah, I think we were on an AICPA call last week, and they said if you filed an amended return, that you could be in a situation where you're waiting 6 to 8 months to get the refund. But Now, maybe the 7,200 is obviously designed for a quicker influx of cash. So hopefully those will move faster than the amended returns.
Right. Yeah, that's a good point. That's a good point. Paula, same question. When are we seeing the refunds? I don't know the answer. Is Whittlesey, our firm, calculating this credit for its clients? Yes, we are. We're doing a lot of that type of work. And then we talked about, some questions. I answered them, but I'll just say it. Some folks were talking about, hey, I've already filed my payroll tax for the quarter. Certainly Q1 is filed, last year is filed. How do we go about getting it? And I'll just say it, you file an amended return, an amended payroll tax return, Form 941X. And so you file it and claim the credit that way. Or when you get to the end of the quarter, as you guys know, June 30th comes to the end of the quarter, I have a month to file that return, or you do the calculation, in the first couple of weeks of July and get it onto the originally filed payroll tax return, as Brian was alluding to, and you get it faster that way. So.
Yeah, you definitely, if you can get it on an originally filed return, that is a preference in terms of getting the money quicker.
Yep. All right, a couple more, Brian, and I'll keep going. It's 1:45, so I'll just keep going with the questions. Here's a good question from Anonymous. Is it a decline in sales or actual cash received? You want to take that one, Brian?
A very good question. Gross receipts is most likely defined based on your accounting method that you use for tax purposes. So, you could be on an accrual basis, you could be on a cash basis. I think if your tax return's on a cash basis, you can probably use the cash receipts. If it's on an accrual basis, you're probably going to be stuck with accrual. If you're a not-for-profit, then you're effectively going to be subject to basically it's gross receipts on your 990. So there's a specific rule for not-for-profits.
Yeah. Barry said, I assume that if my Q2 revenue is down 20% versus 19, I may be ERC eligible. Absolutely. It's an either or test. If you meet the revenue test, what you're talking about, you'll hit it. If not, you go into the weeds like Brian was talking about. Another question about the deadline for amending the returns. There isn't really, there's not a pressing deadline. If you filed Q1 or if you're going to use Q4 of 2020, you generally have 36 months or 3 years from the filing to amend those. So I wouldn't wait, but we're definitely within the time period to amend now. So get going.
The other thing was we would encourage people to amend sooner rather than later, because I'm not so sure that the government realized how much money is going to be paid out in this program, and I think at some point they're going to come to the realization that this program was broader than they expected. So I would think if you're eligible, you definitely want to kind of get moving on the amended returns, or if you're filing an original Q2 filing, then include it on your Q2 filing.
Yeah, agreed. Is there any connection between the ERC and the payroll tax deferral in 2020?
No, there is no separate programs.
Yeah, separate. Brenden said Q1 of 2021 can be compared with Q4 of 2020 in an answer as I was typing while you were talking, Brian.
Yeah.
Are there any caveats? So let me just clarify. So generally you look at 2019 as the base year and compare it to either your quarter in 2020 or each quarter in 2021. There's a special rule. I don't know why they did it. But the IRS says you can look at Q4 of 19 versus Q4 of 20. And if that is 20% or more greater reduction in revenue, you can apply that test to the Q1 of 2021. So you're still looking at 19 versus 20. And normally in the 20 world, it has to be a 50% or greater test. But for this one Q1 of 21, this one quarter, you can also look at Q4 of 19 versus Q4 of 20. And if that difference is 20% or more reduction, you pass the test magically for Q1 of 21. So I hope that clarifies.
And this has been important because we've had clients who didn't have a 20% reduction when you compared Q1 of 2021 to 2019, but they were able to look back to the fourth quarter of 2020 compared to 2019 and get eligibility for the credit. So we have seen situations where someone wouldn't have been eligible under the normal calculation, but they were eligible under the alternative calculation.
That's a good point. How does your payroll service file for ERCs? I don't know that answer. I don't know.
You have to talk to each payroll company. Each payroll company is going to have a different procedure for how they deal with ERC. So I think, talk to your accounting firm, talk to your payroll company. I think, we've actually been amending a fair amount of returns for our clients, I think, because the process is a little bit easier than with the payroll companies. But, like I said, I would certainly check with either and figure out sort of, what your costs and what the effort is going to look like to go forward under either approach.
Yeah. Jay Nardecchia, if I say that right, has an interesting issue. We have a business that previously paid its own employees and would qualify for 2020 filing a 941X. But in 2021, the employees are paid by a new parent. The parent does not qualify for the credit, but the sub LLC still exists from an operating standpoint, just not paying the payroll. How can the subsidiary LLC file for 2021? I don't know that it can. That's a good question. I don't know if it's not paying employees. I doubt it can qualify in 2021. I think you go back in 2020 and get that refund. But yeah, I think you're out of luck.
Yeah, I mean, the only potential argument that I could see is that, if it was a stock acquisition, maybe there's an argument to be made that the wages that are being paid by the parent company would be, could be potentially utilized. But I think it's a long shot. I think that's a tough set of facts and circumstances.
Yeah, I think so too. Sandy wants me to write out the response about that special Q4 thing. So Sandy, I will do my best. I'm not a fast typer, but we still have some time. So let's flip through these questions. And if so, we send out your slides and answers in an email. Good question, Valerie. I don't know if they're proprietary, but Valerie, why don't you, Valerie, you reach out to us. How's that? Valerie, you reach out to us and then we'll talk. Although I believe this is being recorded. So, and I think if I understand it correctly, this will go on the YouTube channel. So you're not losing this stuff. So I want to make sure we covered at least the topics.
The only other question I saw, I'm trying to remember exactly how it was. Oh, do Ppp receipts count against you? They don't. So when you're doing the gross receipts calculation, the Ppp receipts are not included.
That's a good point. But we had a doctor asked a question that I typed. So a lot of medical practices received grant money because they essentially, even though maybe they weren't forced to shut down, they effectively shut down. And so they got grant money from the government. And Brian, correct me if I'm wrong, but we believe that money does count as gross receipts for purposes of this.
Yeah, that's the HHS stimulus money. And the AICPA has been talking to the IRS about this issue. There's been no clear guidance issued regarding it, but informally, the IRS has said that would probably count as gross receipts, the HHS stimulus.
Yep. Here's a good question. So, all right. So Jay Feehan said, so you have to qualify each quarter, not like the PPP, just find one quarter and then good for the year. So for 2021, you have to qualify for each quarter, and you can claim it each quarter, which is wonderful. But for 2020, you just have to find one quarter, just like PPP. So,
And then you continue until you get back to 80% of 2019 revenues. So the example that I gave earlier, if Q2, if you're down 50%, you're eligible. And then if Q3, you're down 25%, you've only made it to 75% of the prior year. So you're still eligible in Q3.
yeah. And then Anonymous said, per my understanding, only the employer Social Security is refundable, but the credit is applied to employee federal withholding, employee Social Security, and Medicare on the 941. And this is a use or lose it credit. If that is correct, can I give bonuses to Q2 to soak up the unused credit? No, it's a refundable credit. And I'm not sure if I understand the question exactly, but it's a refundable credit, meaning it does offset the mechanics of it offset the employer Social Security, but then the balance is refunded to you. So I guess you could argue that it offsets the other stuff, but
I think that it's more of a quirk in the calculation. So the non-refundable piece is the employer's share of the FICA taxes.
right.
So that gets classified as non-refundable, but then the remainder gets classified as refundable. So I think that's more of a quirk in the way the 941 is done rather than a limitation on your ability to get the credit.
Yeah. I think Sandy, and will you assist non-clients with the filings for a fee? Of course, Joanne, just give us a call. We'd be glad to help. Just let us know. Or again, as Brian mentioned, if you just want to talk for a few minutes, we're open to that as well. So whatever we can do to help. This is a great, again, we said it at the start, this is a wonderful program. This is a great credit. And it's really adding up to some serious dollars to employers. And as we get through this pandemic, everything helps. So.
Okay, did we get through all the questions, Brenden?
I think we did materially.
Okay.
Q1. So Sandy, I got to get back to you. Let's try to type out my answer, and then it's how long does it take to get to the refund? And we don't know. We don't know.
Yeah, we don't know that.
Fingers crossed. So.
All right. So I guess if we've answered all the questions, we're going to turn it back over to Molly.
All right. Thanks, everyone.
Thanks, guys. For the attendees, I just really want to quickly share. You guys should be seeing my screen for the Connecticut Tax Conference coming up for CBIA. That's going to be on June 15th. We're asking, if you'd like to attend, it's going to be a virtual program. For CBIA members, it's going to be $50, and for regular admission, it's going to be $125. That program is a half-day program, and it will focus on tax developments and property tax. So we'd love to see you there. And in the chat feature, I will just share a quick link to that program where you can sign up. And I think with that, guys, we're all set. We will be, handing out a copy of the recording of the presentation in a thank you email to attendees after the event. Likely get that on Monday. And then, if you guys have any further questions for Brian and Brenden, you can reach out to them. If you guys shared any contact information, you could be reached there. And I think that's it. So if that's it, guys, I think we can send it off and everybody can have a great Friday afternoon.
Thanks, everybody.
Take care.
Bye-bye.